Welcome to the Riskwiser Zone. I'm your host, Louis. Today, we're diving into a fascinating story that highlights the intricate dance between geopolitics, cryptocurrency, and economic development. Our focus is on Pakistan, a country that's been making waves in the financial world with its growing adoption of digital assets. Recently, Pakistan has been courting U.S. investment, particularly from the Trump family, to develop its virtual asset market. The country boasts an impressive 40 million crypto users with an estimated trading volume of over $300 billion. This has caught the attention of prominent figures like Donald Trump's sons, Eric and Donald Jr., who are co-founders of World Liberty Financial. Pakistan's emergence as a crypto player is largely attributed to the efforts of a key figure, Saqib, who has been instrumental in building relationships with U.S. dignitaries and businesses. His networking skills have led to significant breakthroughs, including a trade deal that cuts tariffs on Pakistani goods to 19%, a notable concession by the U.S. However, this newfound friendship between Pakistan and the U.S. is not without its challenges. The International Monetary Fund has expressed concerns over sovereign crypto experiments, and Pakistan still needs to repay its debts to the IMF. Moreover, the country's defense agreement with Saudi Arabia and potential involvement in regional conflicts could complicate its relationships with other nations. As we explore this complex web of alliances and interests, it's essential to consider the potential risks and benefits for all parties involved. Will Pakistan's gamble on cryptocurrency pay off, or will it face significant setbacks? How will the U.S.-Pakistan partnership evolve, and what implications might it have for global trade and finance? These are just a few of the questions we'll be examining in more depth as we continue to follow this story. For now, it's clear that Pakistan is taking bold steps to diversify its economy and reduce its reliance on traditional aid packages. As the world watches with interest, one thing is certain: the intersection of geopolitics, cryptocurrency, and economic development will remain a critical area of focus for investors, policymakers, and financial experts alike. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating story that explores how rising gas prices are influencing consumer behavior in the automotive market. As we've seen in recent weeks, gas prices have been trending upward, with some states experiencing prices well above the national average. This shift has led to increased interest in electrified vehicles, including hybrids, plug-in hybrids, and battery electric vehicles. According to data from Edmunds.com, shopper consideration of these alternatives has climbed to 23.8% of all vehicle research activity on the platform. This uptick is likely driven by the economic benefits of switching to an electric or hybrid vehicle, with Morgan Stanley analyst Andrew Percoco noting that charging costs for EVs are approximately 60% cheaper than annual fuel costs for gas-powered vehicles. Rivian's CEO R.J. Scaringe believes that prolonged high gas prices will eventually change consumer behavior, stating that, after people have gone through a few cycles of seeing gas at $4 or $5 a gallon, I think it definitely will start to have an impact. This sentiment is echoed by Edmunds' head of insights, Jessica Caldwell, who suggests that while some consumers may absorb the added expense of higher gas prices, others may begin to weigh fuel economy and electrification more seriously when planning their next vehicle purchase. It's essential to consider multiple perspectives on this issue. On one hand, the rising demand for electrified vehicles could lead to increased investment in sustainable energy solutions and reduced carbon emissions. On the other hand, some argue that the higher upfront costs of electric vehicles may be a barrier for many consumers, despite the long-term savings on fuel costs. As we continue to monitor the evolving landscape of the automotive industry, it's clear that rising gas prices are just one factor influencing consumer behavior. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at the latest developments in the tech world, specifically with Meta, the parent company of Facebook and Instagram. Recent earnings reports have shown a mix of growth and increased spending, leaving investors wondering what's next for the social media giant. On one hand, Meta's revenue jumped 24% year-over-year to $59.89 billion, driven by more ads across its platforms, with daily active users rising about 7% year-over-year. The company also remains a cash cow, with free cash flow of around $14.1 billion and a whopping $81.6 billion in cash and marketable securities. On the other hand, expenses swelled 40% to $35.15 billion, primarily due to data center build-outs and research and development, particularly in the realm of artificial intelligence. Reality Labs, Meta's virtual reality division, continued to post losses, which are expected to peak in 2026. Analysts have mixed opinions on Meta's stock, with some, like Bank of America and Goldman Sachs, maintaining a buy rating with targets ranging from $835 to $885. Others, such as Morgan Stanley, are more cautious, citing high valuations and concerns about spending. As we weigh the pros and cons, it's essential to consider the potential risks and rewards. Meta's investments in AI could lead to significant productivity gains and returns, but they also come with substantial costs. The company's ability to balance growth with profitability will be crucial in determining its future success. Ultimately, the decision to invest in Meta or any other company should be based on your individual financial goals and risk tolerance. It's essential to do your own research, consider multiple perspectives, and consult with a financial advisor if needed. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.